There's a cost to borrowing money, because when you go and borrow money to buy a home, the bank is going to charge you interest. When you go and borrow money on your credit card, your bank is going to charge you interest. Now, when a company charges you $1,000 to buy, say, a phone, but they're willing to sell you this phone at $100 a month with 0% APR, something has to be fishy there, because there's a cost to borrow money. I mean, $1,000 today is worth more than $1,000 a year from now. So if a company is letting you take their product and pay it off in installments, something has to be going on here. Well, there is. And there's the reason why 0% APR is so profitable to companies and is so profitable to banks, because they know that if they can offer you the 0% APR, number one, they're going to be able to sell way more stuff, because more and more people are going to buy this item at 0% APR who can't afford it otherwise. So now you stretch your finances even thinner. And then number two, they also know that when you go into the 0% APR, you're also going to go and buy way more things than you would if you bought the item outright. If you had to buy a $1,000 iPhone outright, you might not buy all the AirPods and all the other accessories with it, but when you're buying it with 0% APR, they know that you're much more likely to buy way more things, because you don't have that same pain of spending the $1,000 today. And then third, because so many people end up overspending with over 0% APR, many people will end up happening is that at the end of the 0% APR term, you're not able to pay it off fast enough, which means now you get slapped with a super high interest rate, which means now not only are they selling you more stuff, they're also still getting the interest. So it's a double whammy where now you're getting hit on spending more money, but then you also pay the interest if you don't pay it off in time. This brings me to money trap number 5, which is you do not plan for a life event. The majority of Americans today don't have $1,000 put aside to protect them against an emergency. Now, the reality is life happens and emergencies happen. This is a part of life. Things will go wrong. Accidents will happen. Kids break their arms. Cars get damaged. Maintenance needs to be done. Windows break. And so now if you don't plan for this, you're going to be the one that pays the price. Now, on one hand, that means having a savings cushion. That way, when things go wrong, you don't have to go into debt to cover that savings cushion. But that also means planning for economic slowdowns. We have seen economic slowdowns happen in the United States pretty much every decade or so. In fact, after the 2008 crash was when we saw the longest period in our modern American history, like over the last century or so, without a recession. Meaning from the Great Depression until now, the longest period that our United States economy has gone without a recession was between 2008 and 2020. And so now when we know recessions are a part of our economic system, market crashes happen. When you see a recession, asset prices go down. When we see this happen, why are people always so surprised when a recession hits? Because people never want to assume something bad will happen. When things go wrong and things are bad, people assume that nothing good will ever happen again. And likewise, when things are booming, things are good, the economy is growing, nobody thinks that anything bad could ever happen. And then when nobody thinks anything bad could ever happen, they don't prepare or plan for anything bad happening. So that way, when something bad does happen, because it's inevitable, bad things happen. Nothing can go up forever, just like nothing can go down forever, unless it goes to bankrupt. But nothing can go up forever. And so if you plan for everything to just go up in perpetuity, what's going to happen? You're setting yourself up for disaster and failure, which is why you want to be prepared. And this is where you prepare your finances by having some savings cushion put aside, but also being ready to capitalize on investment opportunities and understanding that nothing can go straight up forever. That way you are not shocked and blindsided when bad things happen in the economy, because you've looked at history and you see, oh my God, we had a recession in 2020. Oh my God, we had a recession in 2008. Oh my God, we had a recession in 2000 and 2001. This could happen again. So how do I prepare? That way now I'm not blindsided, but I can also capitalize on what's happening around me. And this is where you prepare for anything to go wrong. The saying is hope for the best, but plan for the worst. But what ends up happening for the majority of people is they hope for the best and plan for nothing. The 6th trap that you want to avoid is saving all of your money. Now, saving money is better than spending all of your money, but the unfortunate reality with saving your money, especially in this economic system, is that when you save your money, your savings get eaten away by inflation. Inflation has been around for a long time. It's been around since before the pandemic, and it only became a big deal after the pandemic because of how fast inflation started to accelerate. But before the pandemic, your savings were still being eaten away by inflation, although maybe it was only 1 or 2% that your savings were being decreased by. But now with high inflation, it has become so much more important for you to become financially educated, which is where you don't want to save all of your money. If the inflation rate is higher than the interest rate you're getting from your savings, that means your savings are slowly losing value. And now there's a lot of things that you can do with these savings. Obviously, you want to have some cash put aside to protect you against an emergency, and you want to have cash put aside to take advantage of investment opportunities. But then you also want to be investing your money. Now, you can invest this money into your own financial education. You can invest this money into your own business idea. You can invest this money into other people's business ideas, startups. You can invest this money into stocks. You can invest this money into real estate. You can look into investing some of this money into physical gold. There are an infinite number of ways that you can invest this money. But the key is when you keep that savings all in cash, well, those savings are being eaten away. And the value of those savings are slowly dropping. So you're working hard to save money. But then as the Fed prints money, the hard work that you're working to save is slowly being eaten away. Like savings, or money rather, is not a very good store of value. If you go to work and you earn $100,000, the 40 or 50 or 60 or 100 hours a week that you put in to earn that $100,000 is symbolized through the $100,000 in cash that you saved. Now, if you saved every one of those dollars that you earned, if you saved all $100,000 and you put it in the bank, well, that $100,000 is a symbol or depiction or value of how much work and effort you provided. Well, 10 years from now, that $100,000 that you have in the bank is not going to be able to buy what $100,000 can today. That doesn't mean that the work or value that you provided has diminished. It means that the store of value which you used to depict how much effort you put in your job has lost value. And so that currency, that cash, is losing value, which is why you want to convert that dead cash into something that also produces value, whether it be in businesses or real estate or something else, where now you're putting that cash to work. But of course, you got to be smart with this. You don't want to just throw your money into investments when it's not a good investment or when it's not a good time to invest, but you have to be educated enough to understand that saving your money is not how you become wealthy. Although most of us were taught that, that's not the reality. If you want to become wealthy, you cannot save your way to wealth. You have to invest your way to wealth. You have to own the assets, and saving your money has to be done strategically. The seventh trap that you want to avoid is avoid high-risk schemes. We all know some people or multiple people that are looking for the next hot thing to get rich quick. Now, nobody wants to call it a get rich scheme because that would be way too obvious. Instead, you look for the next hot thing, the next hot investment, the next hot cryptocurrency, the next hot meme stock. That way you can throw your money in there and hopefully make a lot of money. And maybe you can find it early enough that way you can make that money early on. But the reality is now, the higher the risk you take, the higher chance you have to lose all of your money. Sure, you can see huge returns, but you can also lose all that money just as fast. And this is where now you have to understand that there's a cost to taking all these get-rich-quick investments or schemes or whatever you want to call it, because if you keep losing your money in these things, that's money that isn't being compounded or invested into something that can actually grow sustainably and build you real wealth. And so now if something seems too good to be true, it probably is, but also understand that if you want to build real sustainable wealth, you have to put your money into assets. For me, the bulk of my investments are into sustainable investments that have proven the test of time. That's about 80% of my investments. The other 20% are more of what I call speculative investments. Some of these are startup investments. Startup investments have the ability to make a lot of money, but statistics show us that the average startup investment will fail. Somewhere between 8 to 9 startup investments will go bust or bankrupt in the first 5 years. So most startups that I invest in will probably fail. I understand that. I also invest in cryptocurrency. Now, cryptocurrency is very volatile. It can go up very quickly and it can go down just as quickly. Now, I believe in the value of the blockchain and the future of cryptocurrency, which is why I buy it, but I also understand how volatile it is, and I understand that it can go to zero. If it goes to zero, is it going to affect me? No, not really, because there's a small piece of my investment portfolio, although I do believe in it. It's still not a huge chunk of my investment portfolio. I also own some physical gold. This is about 2% of my total investment portfolio, because this is an alternative way for me to save hard money. But I also don't dump all of my money into gold because it doesn't really produce any value. It just sits there and looks back at me. And so now, if you're going to be investing your money into, say, the more fun, more speculative types of investments, fine. But just make sure you understand where it fits in your investment portfolio. It's okay to have some fun with some of your money in your investments, but you have to know where it fits within your investment portfolio. For me, it's now maybe about 20% of my investment portfolio total, which includes my cryptocurrency, my startup investments, and my physical gold. Before it was only around 10%, then recently I expanded it to closer to 20% because I have been able to build more wealth, so I can afford to have more money in my speculative investments. But this is where you have to find what's the right number for you and understand that sure, these speculative investments could grow very fast, but they probably won't. And if they don't, are you going to be okay? So you have to make sure you look at your investment portfolio in a holistic manner and understand how you're going to actually build your wealth. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.